Evening, it's Quant Trade Edge, and today I wanted to take a look at the S&P 500 and show you a little trick that we do at our Discord every time there's significant news, like there was today with the CPI. What we do is before the CPI, and it may be 5 or 10 minutes before, it doesn't have to be exact, I had a rough level of 56.22 when I checked the straddle, and what I do is I pull up the futures options 0 DTE at the money straddle. So I probably pulled up 56.25 at the time, and the straddle was exactly 72 points, and at the time it was 56.22 or so was the price. So that had me drawing in this line here at 55.50, which is 72 points below that price. And I believe a number I had up above was 56.94. That was also 72 points above. And what that just means is anyone who is long this straddle is expecting prices to move by more than 72 points from when the news is released. Because if they own the straddle, you would have to move by more than that for them to net make money on their straddle. And what they can do is if price gets up to here, they could just short the notional and end up with twice as much put. Or if they come down here, they could have resting orders to buy the notional, buy the underlying S&P contracts, and all of their puts get converted into calls. And what we find out is if immediately upon the news you bust through one of these levels, then you tend to create a positive feedback loop where the market will continue to trend in that direction, whether it be up through the upper boundary or down through the lower boundary. If, however, you just spend a lot of time to just barely get there, it often serves as support at the lower boundary or resistance at the upper boundary. And what was doubly special today was, it did take its sweet time coming down here, and it was about 10:05 in the morning when we got near lower boundary. It was 50.25 was the low. If we want to get really technical, this open was 24.25, so it would have been 52.25 would have been the exact boundary. I had it drawn in a little bit lower just because of whatever the price was at the time that I measured it a few minutes before the news. But you'll notice here we have this green dot which stands for an anticlimax. And what an anticlimax is when the distance between the low here and the low here, which, we'll just go ahead and calculate it. This low was 73, this low was 68.25, so 4.75 points. And then the low between here and here accelerates. So we're looking for something greater than 4.75. We have 68.25 to 60, so this was 8.25. And then for one more bar, it also accelerates again. So here you went from 60 to 50.25, 9.75. So 475, 825, 975. That creates an anticlimax. Now the trigger to enter an anticlimax is sometimes this bar itself can have a green body, but if it doesn't, you wait for the next candle to put up a green body like this did, and you buy above that with the stop below the low of the anticlimax pattern. So in this case, you would have bought at 65 and a quarter, and your stop would have been 50, a tick below. And that's about 15 points, and we got, I believe, about 60 points from there. So 65 plus 60 would have been 625, 56.25, and we did get all the way up to 56.2650. So roughly from this setup, we made 4 times our risk. So there's two things here. The Anticlimax is just an entry. I wouldn't necessarily go enter every Anticlimax I see, but here we had the confluence of that Anticlimax pattern coming in at what I call lower boundary, which is the price that we had right before the CPI release minus the at-the-money straddle, the 0 DTE at-the-money straddle. Tomorrow's PPI, we're going to do the same thing. My guess is that it won't be 72. It'll probably be in the 60 range. And that is in part because the PPI news is not as market moving as the CPI news. But also, this is the chart of the VIX, and we did have volatility come off. And more specifically, this is what Larry McMillan calls a VIX spike. When you get a close that is 3 points higher, when you get a high that is 3 points higher than a close from 3 bars ago. So we basically went into a spike from here. This is 1566, and this high was 2148. Now that spike is not relieved until you close 3 points below the head of the spike. So that spike was 2148. You would need to close 1848. That didn't happen here. Then you got a new spike high of 2240, but you closed at 1963. Didn't happen again. You got a new spike here, 2635, and 2635. You closed at 2351. You didn't get that, but you did get it on the next bar. On the next bar, you had 2193 coming off of this 26, but that didn't last very long. Next bar went higher, next bar went higher, next bar went higher. We ended up at 2956. This is 2692. Today's close cements that VIX that we've seen is the high. So that does give me a bit of a bias that the market will probably want to go higher as VIX continues to come off. The other thing that's interesting here is when you look at the way the VIX tends to spike, this spike here was last August, and 1, 2, bam, even here, a couple of 1, 2 days, bam, 1, 2 days, bam, here, 1 day, bam, back off, 1 day, same day off, gap up, come down. What was really interesting about this spike is that it was very steady. It was kind of a really steady move up. And then maybe a bit of a climax here because we did take out this level here, 2832, 2956. So that's also just, something that, each of these would have been a reversal, a very quick pullback reversal in the market. This was a much more prolonged pullback. And we'll see, for all we know, this could spike up again tomorrow. But it does feel like this part has passed. The other thing that's interesting to note is the spike started on February 21st, which is options expiration. And right now we're only at March 12th. This Friday will be March 14th, but we don't have options expiration until next next Friday, which is March 21st. I jumped charts here to show you something else that was really interesting, and that is if we go back to COVID, this is October 2019, and we had this nice rally all the way up to February of 2020. This day right here, that was options expiration Friday for February. And the entire COVID pullback happened over one option cycle. And this right here, this big day here, was March 20th, options expiration for March. One little day of overshoot here, and then we just bounced back. So putting that in the context of today, this very first big down day was options expiration February. So as much as I like the VIX configuration and the fact that we've already come down roughly 10%, in fact, I think on SPY we missed it by about 11 cents. So it's kind of interesting that it's just shy of 10. Maybe we have another push down to get our 10. But from a time perspective, I kind of want to let a few more days roll off. We have March 12th. Let's get through, PPI tomorrow and then Friday, and then we have 5 more days before March options expiration. And I just have a feeling that, from a timing cycle standpoint, once we get done with the March expiration, that should then help relieve the pressure that's in there. Because I believe some of these turning points happen because of the way options market makers are, have their inventory, have their books balanced. And so, while you can have price targets, you can have volatility targets and signals, there's also just a little bit of timing where I do want to be cautious until March rolls off the board. But I do think most of the damage is done, and we're in the process of hammering out a bottom here over the next 7 or so trading days. So anyway, that was just our, I guess I got off topic here. That was off, this was about using the straddle to figure out the boundaries to help pick a bounce. But then we went into the VIX, and I just wanted to also give you that point of view that I'm waiting for the March option cycle to complete before getting more aggressive with longs in this market. So anyway, I hope you had a good day out there. If you like analysis like this, join our Discord, and I'll put a link in the description.